Welcome to the video on building wealth, the boring but powerful way. In this session, we will emphasize why starting debt-free is a massive advantage and how simple, consistent investing beats speculation over the long run. To set the stage, we will outline a practical path: eliminate high-interest debt, build an emergency fund, invest in diversified low-cost index funds, and automate contributions while staying disciplined through market ups and downs. As we move forward, we'll also cover tax-advantaged accounts and practical steps you can take today. First, we will preview the map, starting with why boring investing wins, moving into building a debt-free foundation and emergency fund, and then tackling long-term index investing basics. Next, we will walk through tax-advantaged accounts in the right order of operations, followed by the behavioral and automation strategies that keep you on track. Additionally, we will reinforce learning with diagrams and quick quizzes. Finally, we will close with key takeaways and practical next steps. Before we dive in, a quick but important note. This video is for educational purposes only and does not constitute financial, legal, or tax advice. Your situation is unique, so you should do your own research and consider consulting a qualified professional. With that established, let's proceed to the practical steps. To begin, we must address high-interest debt. Credit card and other high APR loans create reverse compounding that drags your finances backward. Therefore, it is crucial to eliminate high-interest balances before investing. By removing this drag, your future contributions can work for you, not against you. Now that we have set this priority, we can talk about establishing your safety net. Next, once high-interest debt is addressed, the focus shifts to your emergency fund. Aim for 3 to 6 months of essential expenses and store it in a high-yield savings account. The goal is liquidity and safety, not investment returns, because the emergency fund protects you from needing to liquidate investments during downturns. Additionally, do not invest money required within the next 5 years to avoid forced selling at the wrong time. With this foundation, you now have the stability to invest for the long term. Moving on, here is a simple process to build your emergency fund. First, list essential monthly expenses. Second, multiply that number by 3 to 6 to get your target range. Third, open a no-fee high-yield savings account at an insured institution. Fourth, set up automatic transfers from each paycheck. Finally, once you reach your target, stop adding to the emergency fund and redirect those automatic transfers into investments. This systematic approach ensures steady progress with minimal decision fatigue. Now, to make the sequence clear, this flowchart visualizes the order of operations. First, if you have high-interest debt, pay it down. Otherwise, build a 3 to 6 month emergency fund in a high-yield savings account. Next, contribute to your employer's retirement plan, at least up to the company match. After that, prioritize funding a Roth-ira. Then invest in diversified total market index funds. Following that, automate your contributions. Finally, maintain discipline by rebalancing periodically and refusing to panic sell during downturns. This sequence maximizes both safety and growth. Quick checkpoint. The question is, how much should your emergency fund typically cover, and where should it be kept? Your options are 1. 1 month of expenses in a brokerage account. 2. 3 to 6 months of expenses in a high-yield savings account. 3. 12 months of expenses in cash at home. And 4. 2 months of expenses in a certificate of deposit. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is 3 to 6 months of expenses in a high-yield savings account. This balances liquidity and safety while providing some interest. Keeping the emergency fund in a brokerage account or at home introduces unnecessary risk or insufficient safety, and locking it into a certificate of deposit can reduce accessibility when emergencies happen. With your foundation set, we can turn to the core investing strategy. The focus is on diversified, low-cost index funds and exchange-traded funds that track the total market. Because markets grow with global productivity over long periods, simply owning the market and minimizing costs is a robust approach. Moreover, time in the market consistently beats attempts at timing the market. Now let's translate this into actionable principles. To put the philosophy into practice, pick broad, low-cost index funds or ETFs that mirror the total stock market. Keeping fees low is essential because even small expense ratios compound over time. Next, commit to staying invested through volatility. Selling during downturns, locks in losses, and undermines long-term returns. Instead, contribute on a consistent schedule and rebalance periodically to maintain your target allocation. The pie chart illustrates an example allocation across U.S. stocks, international stocks, bonds, and cash. This is not personalized advice, but rather a conceptual example to show diversification. The key takeaway is that time and consistency outweigh attempts to speculate or beat the market. Furthermore, maximize tax efficiency in the right order. First, contribute to your employer plan, such as a 401k, at least up to the full company match. This is effectively free money. Second, prioritize a Roth-ira, which can be especially beneficial for younger investors due to tax-free growth of earnings. Roth IRAs may allow principal contributions to be withdrawn without penalty and offer certain exceptions for a first-time home purchase. Always verify rules for your jurisdiction and situation. Third, once those accounts are funded, use a standard taxable brokerage account to continue investing with accessible funds. Finally, automate transfers from each paycheck so that you pay yourself first and maintain long-term discipline with minimal friction. Another quick check. The question is, what is generally the most advantageous first step for tax efficiency if available? Your options are: 1. Max out a taxable brokerage account. 2. Contribute to your employer plan to get the full company match. 3. Open a margin account and day trade. And 4. Only invest after building a 12-month emergency fund. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is to contribute to your employer plan to receive the full company match. This match is effectively an immediate return on your contribution, making it a priority. While a taxable brokerage account is useful later, it generally comes after securing the match and funding tax-advantaged accounts. At this point, success becomes a behavioral game. Automate transfers so your investments are funded before you can spend the money. This reduces decision fatigue and avoids the temptation of timing the market. Limit how often you check your portfolio. Quarterly check-ins are sufficient for most long-term investors. Additionally, pre-commit in writing that you will not sell during market downturns, because panic selling crystallizes losses. Rebalance on a predetermined schedule instead of reacting to news headlines. This structure helps you maintain consistency over many years. Finally, let's visualize how compounding rewards patience. In the early years, your contributions drive most of the growth, and building the habit is essential. Around year 5 to 10, you begin to see the effects of earning gains. By year 20 and beyond, compounding can dominate the growth of your portfolio, often outpacing the impact of new contributions. This timeline underscores that your true edge is a combination of time, consistency, and low costs. Therefore, starting early and staying invested are paramount. To recap the essentials, begin by eliminating high-interest debt. Build an emergency fund covering 3 to 6 months of expenses in a high-yield savings account, and avoid investing money you will need in the next 5 years. Use diversified, low-cost index funds to own the market, and prioritize tax-advantaged accounts by capturing the employer match first, then funding a Roth IRA, and finally investing through a taxable brokerage. Automate your contributions, remain calm during market declines, and rebalance periodically while keeping costs low. As we wrap up, the formula is straightforward. Start debt-free to remove reverse compounding. Build a 3 to 6 month emergency fund to protect your plans. Invest for 5 years or longer using diversified, low-cost index funds. Capture tax advantages in the correct order: employer match, Roth IRA, and then taxable accounts. Automate contributions, remain patient, and ride out volatility. Above all, prioritize consistency over speculation. With these habits, you put compounding on your side. Thank you for watching. If you found this valuable, please like the video, share it with someone who needs a simple investing blueprint, and subscribe for more practical content. In the comments, share your current step on the roadmap and your next action toward consistency. Your plan might inspire someone else to begin.